Hey there, investors! Tired of the Wall Street roller coaster? Want a smoother ride to wealth? Then listen up. Dividend investing might be your ticket to financial freedom. It's like getting paid to own a piece of a company. Who wouldn't want that? Forget the day traders and their fancy algorithms. Dividend investing is about patience, discipline, and letting your money work for you. It's a proven strategy for building long-term wealth, and it's easier than you think. So buckle up, and let's dive into the world of dividends. Now, let's break down what dividends actually are. Dividends are a fundamental concept in the world of investing, yet they can often be misunderstood. Simply put, dividends are a share of a company's profits that are paid out to shareholders. When a company earns a profit, it has several options for what to do with that money. It can reinvest it back into the business, pay down debt, or distribute it to shareholders in the form of dividends. Think of it as a thank you for owning their stock. By paying dividends, companies reward their investors for their trust and support. This can be particularly appealing for long-term investors who are looking for a steady income stream. Companies that are profitable and have extra cash often choose to distribute a portion of these profits to their investors. This not only helps to attract and retain investors, but also signals the company's financial health and stability. These distributions can be paid out in cash or in the form of additional shares of stock. Cash dividends provide immediate income, while stock dividends increase the number of shares an investor owns, potentially leading to greater returns in the future. Dividends are typically paid out on a quarterly basis, but some companies pay them annually or even monthly. The frequency of dividend payments can vary widely depending on the company's policies and financial situation. The amount of the dividend is determined by the company's board of directors and is based on factors like the company's financial performance and future outlook. They consider the company's earnings, cash flow, and overall financial health before deciding on the dividend amount. This decision is crucial, as it reflects the company's commitment to returning value to its shareholders, while ensuring it has enough resources to sustain its operations and growth. Understanding dividends is essential for any investor looking to build a diversified and income-generating portfolio. By carefully selecting dividend-paying stocks, investors can enjoy a steady stream of income while also benefiting from potential capital appreciation. In summary, dividends are a powerful tool for wealth creation and financial stability. They provide a tangible return on investment and can be a key component of a successful long-term investment strategy. So, why are dividends so great? Well, for starters, they provide a steady stream of passive income. That means you're earning money without lifting a finger. This income can be used to supplement your living expenses, reinvest back into the market, or simply enjoy life's little luxuries. But dividends aren't just about income. They can also fuel your portfolio's growth. When you reinvest your dividends, you're buying more shares of stock, which can compound your returns over time. And let's not forget about stability. Dividend-paying companies tend to be more established and financially sound, which can provide a sense of security in volatile markets. Ready to start building your dividend portfolio? It's an exciting journey that can lead to a steady stream of passive income over time. Great! It's easier than you think. With a bit of research and careful planning, you can create a portfolio that grows and pays you regularly. First, you need to open a brokerage account. This is your gateway to buying and selling stocks. There are plenty of reputable online brokers to choose from, so shop around and find one that meets your needs. Look for features like low fees, user-friendly interfaces, and robust research tools. Once you have an account, it's time to start researching stocks. This is where the fun begins. Look for companies with a history of paying dividends consistently and increasing them over time. These companies are often more stable and reliable. These are known as dividend aristocrats and are a great place to start. They have a proven track record of rewarding their shareholders. Next, check the company's dividend yield, which is the annual dividend payment divided by the stock price. This helps you understand how much return you can expect from your investment. A higher yield generally means a higher payout, but don't chase yield blindly. High yields can sometimes be a sign of trouble. Make sure the company is financially healthy and has a sustainable dividend payout ratio. This means the company can continue paying dividends without compromising its financial stability. Look at metrics like the payout ratio, debt levels, and cash flow to ensure the company is in good shape. Diversification is also key. Don't put all your eggs in one basket. Spread your investments across different sectors and industries to minimize risk. regularly review and adjust your portfolio as needed. Stay informed about the companies you invest in and the overall market conditions. This will help you make informed decisions and keep your portfolio on track. With patience and diligence, you can build a dividend portfolio that provides a steady stream of income and grows over time. Happy investing. Section 5. Dividend yield, a key metric for investors. Dividend yield is a crucial metric for dividend investors. It provides a snapshot of the income you can expect to receive from a stock relative to its price. This metric is particularly important for those who rely on their investments for regular income, such as retirees or those seeking passive income streams. Essentially, dividend yield tells you how much income you can expect to receive from a stock relative to its price. For instance, if a stock has a dividend yield of 4%, it means you will receive $4 in dividends for every $100 you invest in that stock. This can be a significant factor when choosing which stocks to add to your portfolio. To put it simply, a stock with a 4% dividend yield will pay you $4 in dividends for every $100 invested. This straightforward calculation helps investors gauge the potential return on their investment from dividends alone without considering capital gains. However, it's important to remember that dividend yield is not the only factor to consider. While a high dividend yield might seem attractive, it can sometimes be misleading. A high yield can be a red flag, especially if the company has a history of cutting its dividend or if its payout ratio is unsustainable. A high yield can sometimes be a red flag, especially if the company has a history of cutting its dividend or if its payout ratio is unsustainable. It's crucial to look beyond the yield and examine the company's overall financial health. Factors such as earnings growth, debt levels, and cash flow are essential in determining whether a high dividend yield is sustainable in the long term. Always look at the bigger picture and consider the company's overall financial health before investing. A comprehensive analysis will help you make informed decisions and avoid potential pitfalls. Remember, a balanced approach that considers both income and growth potential is key to a successful investment strategy. Section 6. Diversification, spreading your risk. Diversification is key to any successful investment strategy, and dividend investing is no exception. Don't put all your eggs in one basket. Instead, spread your risk by investing in a variety of dividend-paying companies across different sectors and industries. This will help protect your portfolio from losses if one company or sector underperforms. Remember, diversification is your best friend in the market. Section 7. Navigating the risks of dividend investing. Now let's talk about the risks. While dividend investing can be a great way to build wealth, it's not without its downsides. One of the biggest risks is dividend cuts. Companies can cut or eliminate their dividends at any time, which can significantly impact your income stream. Another risk is market risk. Even the most stable dividend-paying companies can see their stock prices fluctuate, especially during market downturns. And don't forget about interest rate risk. When interest rates rise, investors may be less inclined to hold dividend stocks, which can put downward pressure on their prices. Section 8. Dividend cuts. Understanding the warning signs. While dividend cuts can be unpredictable, there are some warning signs to watch out for. Companies with high debt levels, declining earnings, or unsustainable payout ratios may be more likely to cut their dividends. It's also important to keep an eye on industry trends and macroeconomic factors that could impact a company's ability to maintain its dividend. By staying informed and doing your due diligence, you can minimize your risk of dividend cuts. Section 9. Long-term perspective, the key to dividend investing success. Dividend investing is a marathon, not a sprint. It's about building a portfolio of quality companies that can generate consistent income and grow their dividends over time. Don't get discouraged by short-term market fluctuations or the occasional dividend cut. Stay focused on your long-term goals, reinvest your dividends, and let the power of compounding work its magic. Section 10. Resources for dividend investors. Staying informed. Staying informed is crucial for dividend investors. There are plenty of resources available to help you research companies, track your portfolio, and stay up to date on market trends. Websites like Seeking Alpha, Dividend.com, and Sure Dividend provide valuable information and analysis for dividend investors. You can also find dividend information on financial news websites like Bloomberg, Yahoo Finance, and Google Finance. Section 11. Conclusion. Embracing the dividend investing journey. Dividend investing can be a rewarding journey for investors of all levels of experience. By following the tips outlined in this guide, you can build a portfolio of quality companies that can generate passive income and grow your wealth over time. Remember to stay informed, diversify your investments, and maintain a long-term perspective. Happy investing!